Well, good morning, everyone, and welcome to the November version of the Ag Economic Dialogues. Glad you could join us today. We do have a grain commodity side of the coin that we're looking at today as most of our topics. So I'd like to thank our speakers today, Drs. Tong Wang and Lisa Elliott, and Jack Davis, our field specialist, for joining us. So without much further ado, we're going to kick off, and Lisa Elliott will start our discussion today on some of the grain market situations. So I will turn it over to Lisa.
Okay, can you guys hear me?
Very good.
Okay, great. Well, good morning, everyone, and we're glad that you were able to join us today for our dialogues, and it's good to be a part of the dialogues today. Today, I will be speaking about post-harvest grain marketing and risk. So to give you an outline of what I will be speaking about today, first I will start with corn outlook, and that will be followed by the soybean outlook. And within that framework, I will discuss South Dakota basis and net income and risk, along with crop acre changes and revenue, and also include some price technicals. So to begin with corn outlook, we'll first start on the supply side. So here you can see this graphic, and what we're showing here is you can see with the orange line where our acres are at for 2020, we're at 91 million acres. You can see that's slightly up from the previous years. And you can see as well too, our production, which is the blue line, is also slightly up. So it is at 14.5 billion bushels. And as well as our yield is up from 2019. So we are at 175.8 bushels per acre expected. So the real story right now, a lot of it can be shown here in this graphic. And so this is the US corn supply for the 2020-2021 marketing year. So what we've been seeing since August, we can see here this red line is yield. And we can see how the USDA has been dropping the yield over time since August. So back in August, it was expected that we were at 181.8 bushels per acre. And we can see how each month this has dropped. And we can see now for November, we're at the 175.8 bushels per acre. So just from October to November, we have seen a 2.6 bushel per acre decrease. Okay, you can see that with this red line here. Thus, we can see where we started out for production. So back in June of 2020, we were close expected production at 16 billion bushels. Okay, that's the blue line here. The blue line shows production. And we can see how that has decreased, where now our production is pegged at 14.5 billion bushels, okay? So that is the supply side story. So I want to move on to the demand side. And what we can see here is US corn use. So our yellow represents feed and residual, and green is the exports, and the blue is ethanol and byproducts, okay? And if I add in ending stocks, we can see ending stocks there in purple. And we can look at 2019 compared to 2020, and we can see this green box here. we have increased our exports in the corn market. We can see in 2019-2020 marketing year, our exports were at 1.8 billion bushels, where our exports for 2020-2021 is at 2.65 billion bushels. So we can see how our export expectation has increased from the 2019-2020 marketing year. And we can look at our ending stocks here, which are purple, and we can see how we haven't been this low since 2013. So you can see how our ending stocks this year, ending stocks as a percent of total use, is at 11.5%. Okay, where last year ending stocks as a percent of total use was at 14.4%. Okay, so ending stocks have not been this low since the 2015. Now we can see, if we're just focusing here on the US corn use for the 2020-2021 marketing year, again, we have the same color designation for the different categories, and we can see yellow, feed and residual. Our green is the exports, and blue is ethanol and byproducts, and then purple again is the ending stocks. And on the, we can see from where we started out, expectations in May of 2020, the green for our exports, we were at 2.15 billion bushels. And now in November of 2020, our exports are pegged at 2.65 billion bushels. And if we look here, we focus in on our ending stocks for this 2020-2021 marketing year. We can see back in May, we were at 22.4% ending stocks as a percent of total use. And you can see how we have come down since that time period, where back in September, we were at 17.1% ending stocks as a percent of total use, where now we're at that 11.5%. So we've dramatically decreased the ending stocks as a percent of total use. So now for corn, we're pegged at 11.5%. Okay, moving to corn stocks to use and the price relationship. So what we can see here on this figure is corn November projected stocks to use versus November average spot futures, okay? And here's where we're at for 2020. You can see the red dot here for 2020. Like I said, we're pegged at 11.5%. And you can see how that compares to previous years. So you can see the 2019, we were at 13.7%. And what we can see here is this negative relationship between November average monthly prices and stocks to use. So we can see here when we were getting out in the years where we had a higher stocks to use, we can see that relationship with lower November average monthly prices. And we can see the years where we had a lower stocks to use percent for corn. We can see 2010, 2011, 2012, where we got down to 5.8%. And we can see how when we were at lower stocks to use, how that supported higher prices. You can see in those years, we were between 550 and 750 there. And like I said, right now you can see 2020, we're at 11.5%. So kind of this mid-level here on the corn side. So now moving to the US corn export commitments. Okay, this here is representing commitments starting in the new marketing year from 2020-21 and starting from the beginning to up till now, till November. Okay, and we can see our corn export commitments from that time frame, how that compares. And we can see here the composition of this. So purple here, we can see our corn commitments to China. The purple is right here. We can see how that is a lot larger than what we've seen in previous years. We can also see here as well, other countries is up. So we have a lot higher corn export commitments as of right now compared to our previous years, and especially as compared to 2020. So corn outlook and price technicals. So this here is a figure of corn March 2021 futures. And what we can see on this is a Bollinger setting set at a 70 moving day average with a standard deviation of 2.5. And if we were using technicals and we had a signal of when prices went above the Bollinger Band, that could be a sell signal. And you can see that we're on the upper end of this Bollinger Band here, closing in on that upper range. And with that, different option strategies too could be selling a call or buying a put. So corn outlook, looking at South Dakota basis and net income. So what we can see here is corn spot basis for East Central. And that is represented by the blue line down here. And we're a little bit above the average, slightly above the average historical, where we have East Central about 41 cents under. Okay, so we've been strengthening our basis here from back here in September, so it's gotten a little bit stronger. You can see the strong drop off here. So corn basis was strong in January, and then the COVID pandemic reduced ethanol demand, and you can see how that's represented here in this figure. South Dakota corn net income. So we can see how this is really rebound here since, if we look where we were August 10th, net income was pegged at around $24 per acre. And now, as of yesterday, we're at about $199 per acre for corn net income for East Central South Dakota here. If we look at the risk, so corn net income risk here, we can see how the last 5 trading periods here have been some of the highest that we've seen. So transitioning now to the soybean outlook. So I want to first start out with soybean outlook supply. So our US soybean acres in production, it's expected to rebound after the lower acres in 2019. And we can see this in the figure here. We can see where we were in 2019 for planted acres here, the orange line, and planted acres this year at 83.1 million acres. We can see how our production too is higher, where this year we're at production of about 4.17 billion bushels. And if we're looking at yields, we can see too we're higher than last year. Right now we're sitting at 50.7 bushels per acre expected for the United States. So again, an important figure here, similar to what we saw on the corn side. This here is a figure showing where we've been starting from June 2020 for the 2020-2021 marketing year. And we can see, looking here at August, we were expecting yields. USDA's expectation was at 53.3 bushels per acre. And you can see from each month in August, from starting back in August, we can see how yields have been decreased over this time frame. To now, November 2020, we're at 50.7 bushels per acre. And thus, you can see production has decreased from August to November quite dramatically. And we can see for November 2020, production is expected at 4.17 billion bushels. And just the decrease looking from October to November for expectations for corn yields, USDA decreased corn yields by 2.6 bushels per acre. So moving to the demand side, we can see the kind of the teal color here. Exports are a lot larger as compared to if we were looking at 2019, where exports were at 1.7 billion bushels. This year, exports expected at 2.2 billion bushels. And we can focus in on this, where you can really see the change in the exports, the increase, where we've rebounded here since the 2018-2019 marketing year. So US soybean usage, if we look at this, we can see how this has changed from May 2020 to November 2020. And we can see, if we focus on the ending stocks, we can see quite a dramatic picture here. So a lot of support now in the soybean market, just like the corn market. We can see back in May, ending stocks by the USDA were pegged at 405 million bushels. And you can see in August, where we were expected close to 600 million bushels, and we have dramatically decreased from that position, where you can see each month since then. Now we are setting at an expectation of just 190 million bushels. Okay, so a lot of strong fundamental support in the soybean market. So if we're looking at soybean stocks to use and price, again, similar type of figure as on the corn side, we see this negative relationship. So right now, the red dot represents 2020. So stocks to use is set right now by USDA at 4.2%. Okay, and we can see how, when in other years, when we were around this position, we were in 2011 at 6.3, 2010 5.5. We can see in those years here, prices were $11.50 and above. And we can see kind of this, this other where we're seeing stocks to use in these other years higher from the 10% stocks to use to 20%, where we realized lower prices. So we have that negative relationship, and you can see how in these tighter situations, how higher prices are supported. And if we're looking from a historical perspective here from the years of 2011, 2010, 13, and 12, we can see how prices were $11.50 and above. So here, this is the soybean export commitments. And we can see how when our trade dispute started with China, where we were at with soybean export commitments. And we have seen how that has picked up for this marketing year from 2020, 2021. We can see down here where we were in 2018 marketing year. If we were looking specifically, let's see, at commitments to China here. So when our trade conflict started, we can see now where we're at for this marketing year. We've picked up those commitments to China for the 2020-2021 marketing year. And we can see if we put back in Europe, back in 2018, we can see how the Europe commitments increased in that 2017 year when our trade conflict with China began. Now looking at South Dakota bases and net income, we can see what we can see here is for soybean spot bases, and we can see slightly higher in the historical range for East Central. And for November 2020, we're sitting at around 70 cents under. And we can see how the export bids at the PNW, the yellow line, that's kind of, that picked up back in July, but it's kind of tapered off a little bit since that time frame. Similar type of story as in the corn market. So this is South Dakota soybean net income. And we can see as of yesterday, an expected soybean net income of $277 per acre. That's picked up quite dramatically since when we were back here August 11th, 2020, we were at around $129 per acre. So we can see how that has dramatically picked up with the increase in prices that have been realized. And the soybean net income, that uses the cost that Jack Davis puts together. And with our soybean net income, it does not include into any land charges there. So Soybean Outlook price technicals, we can see soybean March 2021 futures, a Bollinger setting of a moving average of 143 days, standard deviation of 2.5. You can just see how we've been shifting. Prices have been going up and staying, just hovering around that upper Bollinger band as we've been as the market has been adjusting to the strong fundamental information. And just concluding thoughts here today. So we've got a really strong fundamental picture for both corn and soybeans. For corn stocks to use, currently we're at 11.5%. We're at that mid-level for corn. For soybean stocks to use, we're sitting at 4.2%. So a pretty low level when you're looking at that from a historical stance. We have we've had really strong exports and strong commitments there. So the story really going forward, a lot of attention will be looking at the South American weather, where they are in La Nina. So there's going to be a lot of focus on the market looking at the weather conditions going forward there. With La Nina, we expect drier conditions in southern Brazil and into Argentina. So that will really be moving into a weather market, as well as the other item going forward will be our exports. How will that pace continue? So that will be something else to monitor, looking at how prices will move going forward. So with that, I would be happy to take questions, and I appreciate your time today being with us. So thank you.
So any questions that anyone had as Lisa went through her presentation today? All right.
I have one if we got time. Lisa, have you? I didn't see, or I didn't look, and I can probably get it by going to those. Are those graphs that you did? Is that on the tools that you guys have developed, or not? Or is that?
Oh, you mean the figures that I've shared today?
Yes.
Jack?
So
Yeah,
so like where my question is going is,
okay.
How do we know when we've kind of reached that export top? Can we tell like what we used to send to when prices were real good? And I was thinking on beans.
Yeah, well, to answer, I guess, the first part of your question, where you can get these figures to look at, and maybe we can put the link here in the chat box, but this is the link to these figures. And so any of you joining us today, if you want to go back and explore some of these figures, you can just do that by clicking on the link, and I can work on getting that in the chat box with you today. Like you've seen in the presentation, the figures are interactive, and so you can click on things, you can zoom on things, you can see where the numbers were. So we'll make sure to provide you with that link. If you're looking, if we want to look here on the soybean side. So this is our commitments.
Okay.
And so this is just looking from commitments for the 2020-2021 marketing year. So you can see, we're at very high levels here, and that's comparing that point in time, to that exact point in time going back historically. So, beginning of the marketing year to November. So we're at a really high level. And you can see how that is broken down into, the various countries there. And, it's with all of the, the trade disputes and things, I'd say it's pretty hard to know exactly where we could top out on that, to, coupling that with, we have a new administration coming in. So I think that's kind of hard to say at this point in time.
Okay.
But you can
see and it helped answer my question, because we're comparing each time frame to the same time frame.
Exactly.
Versus a total exports for the marketing year.
That's right, Jack.
Okay. Thank you.
You're welcome. Thanks, Jack, for your question. Are there any other questions?
I don't have any in the chat, Lisa, and I don't see anybody else unmuting their microphone. So if you do have questions for Lisa, as we go through the rest of the presentation, feel free to type them in and we will get them answered for you. So
Okay,
With
sounds
that,
good. Thank you.
thanks, Lisa. With that, I think we're going to run into Tong and have her pull up her screens, and she's going to share a little bit of a research project that she's been working on some crop rotations. So Tong, I will have you share your screen, and we will go from there. So we can see your slides now, Tong. I need you to unmute your microphone yet.
Okay.
And there you go.
Okay, so can you hear me now?
Yep.
Okay, yeah. So thank you everyone for joining us today. And so today my topic will be the economics of different crop rotation systems. I'm an advanced production specialist in the South Dakota State University. So first I will give you some background of our study. So here I present the graph with a 15-year trend of how the different crops have basically harvest acres have evolved in South Dakota. So from 2012 to 2017. So we can see from this graph that 2012, actually based on 2002, corn and soybean, we have 57% together of the harvested acres. But this two crops has been growing in harvested acres since then. And then we found in 2017, we have 70% of harvest acres for corn and soybean. So this is in South Dakota. And then actually in the whole United States, the length of complexity of cropping system have decreased as well. So we think a plausible reason for the low crop diversity is basically due to the higher net returns with the corn soybean rotation compared to the other rotations. So therefore, our study aims to compare the profitability of different crop systems based on the market price in the recent years. So here is our research station. So basically this research is mainly done in South Dakota State University Southeast Research Farm in Beresford, South Dakota. So this is a picture of the farm. And for the farm management practices, we have the no-till system and the conventional till system. So for the no-till system, the plots have not been tilled since the trial began in 1991. And we have 3 crop rotations, the 2-year, 3-year, and 4-year. So for the 2-year, we have conventional corn and soybean, and 3-year, we added oats. And for the 4-year, we added a further crop is winter wheat. So for all the 3 crop rotations, we have those treatment managed both with no-till and conventional tillage systems. So our data collection is, first of all, we collect the field data annually at the research site, which includes the timing and number of field operations performed. And we collect data on the input quantities like seeds, quantities, fertilizer, and pesticides. And we also collect data on the crop yield. So for the 4 crops. And for the price data, we collect the secondary price data to estimate the specific management costs and returns. So those includes the output price data obtained from the USDA NAS from 2014 to 2018. So that's the years of our study period. And the average annual market prices received by South Dakota farmers were used for our purpose. And we use an annual input prices for the seed, fertilizer, and crop insurance. Those are obtained from the local agribusinesses. And for the machinery cost, we used the average 5-year average customer rates for North Dakota because we didn't find the corresponding customer rates for South Dakota online. So we use those prices for the planting, fertilizer, herbicide application. harvesting, drying, and hauling. All the customer rates, we obtained those from North Dakota. So here comes our production cost. So we have 4 crops in different rotations, but our production cost for the corn, for example, it does not vary based on the different rotations. So basically all the fertilizer and herbicide use are applied for the conventional rates. And we didn't adjust any fertilizer usage based on the crop rotation. So that means for the production cost for corn, basically for the 2-year corn, 3-year rotation corn, and 4-year rotation corn, basically we have the same production cost. So the corn has the highest production cost based on the seed cost is higher for corn, and the fertilizer cost actually contributes to the higher production cost for corn. And we can see the small grains has the lowest production cost. So that's the average production cost based on 2014 and 18. So for the cost, we don't have any variation based on the plots, but for the yield, we do see a variation here. So here we have divided yield based on the different categories. You can see that we have 3 different categories based on the rotation. So corn and soybean, and then the corn, soybean, oats, corn, soybean, oats, and winter wheat. So those are the rotation, and then we divide them into different tillage practices. So you can see from the bars here, we have the green bars here stand for the no-till, and the yellow bars stand for the conventional tillage. So if you only compare the green versus the yellow bar for each rotation, for example, this corn and soybean, the 2-year rotation, you can see that this no-till bar is shorter than in the yellow bar. So which means that in the 2-year rotation, the corn yield is lower. And similar trends we can observe in the 3-year and 4-year. So the corn yield is lower for all the crop rotations and for the no-till. And if we compare across the rotations, we can say that if we compare across the green bars, we look at the no-till in the 2-year, no-till in the 3-year, and no-till in the 4-year rotation. We can see that no-till in the 4-year rotation has the highest corn yield. And if we compare across the yellow bars as well, we can see that the 3-year and 4-year corn yield has higher yield than the 2-year crop rotation. So average across the no-till and tillage, we can see that the corn yield in the 4-year was 6% greater than the 2-year rotations. And so basically, we can say the corn yield is compromised under the no-till system. So one reason we think can explain this lower corn yield and the no-till is the perhaps because during the early planting season, we have wetter soil conditions, and no-till have greater residue retention, so which could interfere with the seed germination of corn, so which could cause a lower corn yield. So next we look at the soybean yield. Again, we break up according to the no-till tillage and according to the rotations. So for the soybean yield, we see it's a different trend. If you look at the green bar and the yellow bar again, so for corn and the soybean rotation, the 2-year rotation, we can see the no-till actually generates a much higher yield. And for the 3-year rotation, no-till is a little bit lower, but for the 4-year is comparable yield for the soybean. So average across the tillage and the no-till, basically the soybean yield for the 4-year is 4% greater than the 2-year. It's mostly because of a 2-year conventional tillage has a much lower yield here. And compare with corn and soybean, our study shows the effect of tillage depends on crops. So while the no-till system is actually compromised the corn yield, but it actually has some benefits on the soybean yield, as we can see from this picture, especially for the 2-year crop rotation. And next, what we compare is the corn net returns. So we compare the yield. We know that the yield has been compromised through the no-till treatment. However, if we compare the net returns, if you look at the 2-year and 4-year crop rotation, we can see that 2-year and 4-year no-till actually generates slightly higher crop returns. Corn net returns, and the 3-year is a little bit lower. 3-year is lower, but the 2-year, 4-year is higher on average. So if we average across all the different crop rotations, we see that tillage actually does not affect the net return for corn. So if we look at the soybean net returns, so as we know that soybean yield is a little bit higher under the 2-year and the 4-year, except for the 3-year. But if we look at net returns, we can see that the soybean net returns for the no-till, if you look at the green bar, actually the green bar is consistently higher for all the crop rotations. It's especially so for the 2-year crop rotation for the corn and soybean. If we average across all the crop rotations, we find out that the no-till plus actually generates an increase in soybean profit by 10.4% as compared to the conventional tillage plus. So here we are going to compare the net returns from the farm management practices. So just now what I did is compare only the corn and the soybean alone. But right now what I did is I pull up all the crops, not just the corn and soybeans, but corn and soybean in the 2-year rotation, but corn, soybean, and oats in the 3-year rotation, and then added on winter wheat in the 4-year rotation. So we have all those crops profit added together on a per acre basis. So if we compare between the 2-year, 3-year, and 4-year, we can see the 3-year net return is slightly lower than the 2-year, and the 4-year rotation is lower than the 3-year. So the reason for this lower return for the 3-year and 4-year is basically we have the small grains added in, and we found that the profit for the small grains actually is lower than the corn and soybeans. So that explains why the 3-year and 4-year has lower profit. One thing we want to note here is we use average commodity prices for oat and winter wheat, which could be less than those producers who actually sell the small grain directly to the grain mills or receive much higher contractual payment than the standard payment we have here. So that's one reason we have lower profit. And another thing we didn't consider is the other benefits from the diversified crop rotations. For example, diversified crop rotations could have the benefits of weight suppression and have generated nitrogen credit, which we didn't account for. And we also didn't account for the small grains straw value here, so we didn't consider those in our study. So if we consider those, maybe these 3-year and 4-year could be increased somehow. And another thing we think is what we should do is to identify some other profitable crops. So for our current diversified crop rotation, we only include oats and winter wheat. Both of them are small grains. We think that actually compromise overall profitability due to lower profits of those small grains. So what we did is we try to identify some other crops that further diversify the corn and soybean rotations and are beneficial for the soil and the environment. So here we did another study using 3 4-year diversified crop rotations. So those are, we added the P here in the first 4-year diversified crop rotation, which is corn, pea, winter wheat, and soybean. The second one is corn, soybean, spring wheat, and pea. And the third one is the same as before. It's corn, oats, winter wheat, and soybean. So this we have compared, use this 4-year rotation before. And the So we compared this 3 4-year rotations against corn and soybean rotation. So this is a different study. We use 2013 and 2016 data, and this location is also different. Instead of the location near Bradford, here we have the eastern South Dakota Soil and Water Research Farm near Brookings, South Dakota. So different location, and we have different nitrogen application rates as well. So here in 2013, we have the nitrogen applied to all the plots at the following rates. For the corn, it's 90 pounds per acre, oats is 103 pounds per acre, and the winter spring wheat are both 116 pounds per acre. And afterwards, we reduced the nitrogen fertilizer application rates, and the reduced rates actually follows the soil testing results and the recommendations from SCSU soil testing lab with the 85% of the crop yield goal. And therefore, the pea and soybean, there's no fertilizer applied. So this is the new experiment with a reduced fertilizer rate. So here, this is the net return for the 3 4-year rotation compared with a corn and soybean rotation. So we can see that this corn, oats, winter wheat, and soybean, this is the 4-year rotation. We used it before, and we can see still here, if this 4-year rotation compared to the corn soybean rotation, it still generates much lower profit. But if you look at other 4-year rotations, so we can see across all the crop rotations, the corn, soybean, spring wheat, and pea rotation actually generate the highest net revenue, and is even higher than the 2-year rotation. So, and the other crop rotation involves corn, pea, and winter wheat, and soybeans. It's slightly lower than the corn soybean rotation, but it's not significantly lower than the 2-year rotation. So this suggests that not all 4-year rotation generates much lower returns than the 2-year rotation. If we can identify some proper crops, it could generate a better net return as well. Okay, so to sum it up, here are our concluding remarks. So comparing the no-till system with the tillage system, we found that the no-till system have increased the soybean yield, but not corn yield. However, if we compare the economic returns, we find that the no-till actually generated economically equivalent returns compared to the conventional tillage. For corn and for soybean, it's even better, especially for the 2-year crop rotation. We have no-till generates much higher crop returns for soybean. And we found that for the diversified crop rotation that contains small grains, it actually increased the corn and soybean yield in those rotations and the corn and soybean profits. However, because of the lower profits of the small grains, it has compromised the overall profitability of the system. However, we found that if we look for the other crops, if we expand the commonly used corn soybean rotation to the more diversified corn soybean spring wheat pea rotation, which reduced the fertilizer input, and meanwhile it actually increased the system's resilience and the economic profitability. So that's our conclusion. And thank you so much for your attention. And if you have any questions, please let me know. Thank you.
So thank you, Tong, for sharing that new research with us. Any questions for Tong from anybody out there right now? I don't have any in the chat.
Yes.
Very interesting stuff. Yes, David.
This is David. I was wondering if the corn, pea, winter wheat, soybean was a 4-year or a 3-year rotation.
It's a 4-year rotation. You mean this one, the corn, soybean?
Okay, so none of these were
wheat,
double cropped.
Yeah, it's a 4-year rotation. Yeah, it's not double cropped. Yes.
Any other questions out there? Okay, due to time and not because I don't want to hear your questions, we're going to roll right into Jack Davis and talk a little bit about some crop budgets there. So I will let him share his screen and we'll take off on that route. And while Jack pulls up his screen quick, just to let everyone know, I will be sending this out as a link. If you were only able to join us for the 1 hour and it looks like we're going to run over a little bit today, you will get the full link and the information that way coming up. So with that, Jack, if you unmute your microphone, I'll mute mine and take it away. Except you're already taking it away.
Yes, I am. I'm going right after it. So here we have our crop budgets for 2021, and really our costs are staying the same pretty well as what we had in 20. Not seeing too much of an increase. I am concerned probably that machinery costs could start to creep up again on guys as we're maybe have pushed off some of those updates and maybe repairs, or if we got to make an update to equipment, those could start to increase. And I did increase them a little bit in these budgets. And that really varies across farms, but these are the numbers that I've put together based on some historic data and talking with dealers and producers. So much better outlook, at least on paper, than we have had in recent years. And both actually really kind of all the way across the board, except maybe spring wheat there. And that could just be a yield deal that's maybe dragging us down. So if we go to our next slide, maybe. And why don't I want to advance? There we go. So just looking, these is just budget, not actuals. So a budget comparison. And I guess what I wanted to point out was that bottom return to land, how we have come up, and at least on paper now, we're looking better than, quite a bit better than we were in 2019. And of course, 2019 weather-wise was really tough on guys. We kind of got bailed out by some support and government payments that helped financially help pull guys through. But I think we have some opportunities coming forward in this 2021 crop and finishing out marketing of the 2020 crop to help build back some of that working capital and add some profitability back in. So just taking, this is data from FinBin and would be from like our Center for Farm Management out of Mitchell, people that are involved in that. Those farms would submit records to this, and then other associations in the other states. So I use those 4 states that are listed on the bottom: North Dakota, Nebraska, Minnesota, and South Dakota. And I queried it for 1,000 to 2,000 acre farms, and just wanted to show average corn costs. And it's broken into quintals. So it's a top 20% and then the mid. So that 40 to 60% profit level is how I sorted them. And just wanted to show a comparison between those. And I guess maybe if I can get my pointer to go, back here in our heyday, we were, and I'm working with corn, grossing 926 on our top level. And, that just really slipped off coming out of that. And now looking forward, well, this is actually 2019 on our top end, but looking better, maybe come out better in 2019 with some support and insurance. In 2020, as we saw, 2021, as we saw in the budgets, is probably looking better yet. So just wanted to quickly highlight, I've switched here up a little bit and highlighting the difference between the top 40% and then the mid level. So I went down a tier and got 2 tiers in that top 40. And there is their gross sales for 2019, what they ended up. About $60 to $70 in there was crop insurance and government support type items out of those sales. And so just want to highlight those differences. You know, a $76 difference in gross sales and $15 difference in direct expenses. They were even on overhead. So $91 difference between our top level and the mid level. And then looking off to the side, the other graph is just the top 4 or 5 expenses that I picked out and seeing where those fall between the different tiers of profit. So just isolating that, $91 an acre, 21 I'll attribute to a price difference between the two. And what I did there was I used some management accounting principles, and I standardized the yield and standardized price. And I used a standardized price of our reference price. So I used 370 for the reference price, and then did a what I would call a variance analysis. And so isolated price difference at 21, and the rest then being production costs. I'll call it production cost. $26 of it was due to a yield, and another 44 just really in the cost. So just showing where they ended up in a difference. And again, you know, if we refer to tongs, it wasn't. I got all rotations are mixed in there, so we don't know on rotations, those types of things. It's just more on how they were managing their profit levels without regard to rotations. I think that. Well, and just kind of sum it up, I think we do have opportunities for profit going forward. Some of the state had very good yields in corn. Probably a lot of the beans have already been sold. I'm guessing that's why we keep driving that price up. Maybe they're not available yet, but we may have some opportunities to look into selling the rest of those at a profitable level and starting to look at next year. And I think then we got to watch that price risk and pay attention to where that is at, and start to lock some in if it gives us those opportunities, and spread it out throughout the year. I think we have huge unknowns that are going to have possibly large impacts, or could, if we get shutdowns, if that becomes severe before vaccine and before this corona thing is cleared up. And then I think we don't know, what happens politically, what happens trade-wise, what happens to fuel. I don't think anything of those will happen suddenly, but I think it's stuff that guys need to be aware of and not just let down on management because we're looking a little favorable at this time. I think those are big uncertainties that we can't really control, but we can control knowing our cost and taking advantage of opportunities when they are available. So that's, I think, what I have for today. I really went through that fairly fast. If you got questions, be sure and ask them. And of course, the sun will rise, and it's all good. That is the James River for 2 years, and it's usually about, let me think here, 30 yards wide. Well, this is about 3/4 of a mile wide. And that is all back in its banks, finally, as of August. So that's a good thing.
Okay, any questions on crop budgets from Jack? Okay, so there's all of Jack's contact info. If you need to get a hold of him, that will be included in the recording as well. So you'll be able to find him there. The last thing that we were going to share with you really fast today was one calculator that we have available on our extension webpage. We call it the storage calculator. So if you're trying to make some of those decisions on grain marketing decisions post-harvest with something that you maybe put in the bin and is currently hanging out in the bin right now, it looks like I'm messing up some things right now as I'm clicking there. You can put in the current future situation. You can include different expected basis numbers in your area or where your elevators might be. It ties in a cost of storage, whether that storage is going to be actual pay an elevator storage cost. It's an opportunity cost if you would sell right now, and based on the value of the commodity, it's the cost of your bin as you're looking at that. So keep those types of things in mind, that just because it's in your own bin, it's not free storage. There's still expenses related to that. And then at the, yep, false. Okay, that's what it thinks of my ideas today. But then at the bottom, it does have some price comparisons over time. It takes in that futures price. It looks at the carry in the market and the storage costs and ties in what your effective cash price will be. So if you're looking at making marketing decisions today for future delivery of the commodity, this does not take into account any snow removal issues that you might have delivering corn in January or February, but it lets you look at what's your price points as you tie in storage costs for more months as you go forward. So take a look at that. It's available for corn, soybeans, spring wheat, winter wheat. And if you have any other commodities that you're growing on your operation, we can sure tweak it and set it up for that as well. So we'll include a link to the storage calculator, the crop budgets, and as well as Lisa's link for all of her slides when I send out the recorded versions. So I think those are the topics that we wanted to share with you today. We wanted to share some information, get some new research information in front of you, and also some tools available to help with your profitability looking at that 21 crop year. So any questions from anybody before we say thank you and let you go for the day? Okay, I don't see any in the chat either. So with that, we will tell you thank you for joining us today. And we'll do this again in December and send that notification out as the day gets closer so that you can join us in December as well. So thank you very much.